So let's look at the illustration number 1. I put it down there for MPV. Yeah? The illustration is on the left hand side and then the answer is on the right hand side. You can stop the video for a while, maybe 5 minutes. That would be the best. 5 minutes, read the information. You may spend some time if you want, look at the right hand side. Take a look at the answer if you want to see whether you are able to come up with the answer or not. Okay, so I will assume that you will have stopped the video and I will continue straight away. For the rest of the video, I will do the same thing also, or you can always pause it for a while. So let's look at the illustration. Basically, it's to calculate the MPV here. So TDC, company listed in Hong Kong Stock Exchange, so they are considering expansion to Brazil. So it is an overseas investment here. And Brazil, they're using BRL, that is a Brazilian real. The investment initial, when you talk about initial, means year 0, right now. Okay, right now, year 0. Initial investment you have to spend here is 50 million Brazilian real. So that is your capital expenditure or capital cash flow in the MPV there. Right, that much you have to spend initially, year 0. 4-year project. So they say that except for overseas nature, except that it is a foreign investment here or overseas investment, of course, it's different than the domestic investment here. Okay, so at least the risk-wise, it could be different. Other than that, it is the same as the company's business activity. Right, so everything same, except that it is the overseas investment, that's all. Okay, so following information, they give us note 1 to note 10 there. So our job here right now is we have to get the operating cash flow and also the capital cash flow. So we know that capital cash flow is 50 million Brazilian real there. So if you look at the information, basically is note 1, 2, 3, they are about operating cash flow. Operating cash flow, reminder, they are revenue, they are the cost on the annual basis every year. Right, So note number 1 say that selling price is 15 Brazilian. 15 Brazilian. And inflation is 5%. So when you see inflation, you have to adjust for the inflation there. Current year means year 0. And operating cash flow, just remember, it has to be at the end of the first year. So it's year 1. Okay, so since this is current, that's now, your selling price has to be 1 year from now. So 15 here, you have to adjust by 5%. And it's 4 years. Every year we adjust by 5%. Note number 2, they are the same except that it is for variable cost only. 6 and then 4%. Okay, and then note number 3 is on the fixed cost. This is again is every year. So this is referring to year 1 already. So at least year 1 you need not adjust the inflation of 6% there. Okay, so fixed cost they say 4.5, and which include annual amortization. Amortization is not a cash flow. So we are calculating MPV here, which you can look at the requirement. We say that should the company take the project or not, it is always, if it's not mentioned, it is MPV. Okay, so your justification, of course, is just MPV only. Positive, you will take the project. Negative, you reject the project there. Okay, so back to the note number 3. So amortization non-cash flow, we have to remove it. So 2 million, you take it out, so it's 2.5 in year 1. Okay, and then after that you adjust by the 6% inflation. So 1, 2, 3, they are actually operating cash flow, and for the revenue, for the variable cost here, you have to multiply by the number of units, which is given in note 11. 2.5 million unit, 4.5, 5.5, and so on there. So these are the operating cash flow. Okay, yeah? So note number 4 is irrelevant. Irrelevant. Because we know the NPV, the discount rate is cost of capital. And later on when we go to the cost of capital, I will explain to you in detail. But for now, one of your costs, actually it is a bank loan of 10% here. And this bank loan, the cost is already incorporated in the cost of capital, which is note number 8. Okay, yeah? So let's jump to note number 8. It says that real cost of capital is 9%. Since that inflation, we have to change this one here to nominal using Fisher's equation. And the inflation is 4.3%. Okay, yeah? So we can always calculate the nominal. And on top of that, there is a difference in the risk. That is overseas and also the domestic. So we have to add on the country risk premium of 5%. That's how we handle. Okay, yeah? So then we get the nominal cost of capital as a discount rate there. Okay, yeah? And number 5, there will be the capital allowance. Okay, yeah? That's where you have the tax save. And here, the capital allowance is said that it's on the 25% reducing balance. Company can claim 25% reducing balance on what? On the capital expenditure. Okay, based on reducing balance, there are basically two methods here, reducing balance or straight line methods. Okay, so on your capital expenditure of 50 million, 50 million, right? We'll go through all this one here. So deduction start from year 1. So if the question actually is silent, we normally assume that your allowance start in year 1 or deduction start in year 1 there. Okay, so we have explained everything except that now the taxation is note number 6. Taxation is 30% and the company pay tax 1 year in arrears, means 1 year later. 1 year delay. This year's profit you pay next year. 1 year delay. Allowance same. This year's allowance you enjoy the tax save the next year. Okay, so we got hold of everything. Now we're going to set it up using cash flow format. Right? So suggestion is your format, you follow this cash flow format here. So you have operating cash flow, which in this case here you have sales, variable cost, fixed cost. So that will be your operating cash flow. Now in exam, you don't use a shortcut or short format. You should write down full cash flow. For short, I just use CF here. And then followed by taxation on the operating cash flow. And then you have the operating cash flow, which is your capital cash flow, which is your initial investment of 50 million there. And then followed by tax save, net cash flow, and then you get the cost of capital, which is discount rate. You got the NPV positive. Then you should put a sentence here, say that you should undertake the project since NPV is positive of this figure here. Alright, so in exam, you follow this format here. And my suggestion is, if you need to do working for operating cash flow, you can first do the working. And then below the operating cash flow on this one here, you can put the working below. Alright, so up to you. You can have all the working below, no problem. Or you can have the working on top first, and then get the operating cash flow, etc. Both are acceptable. Okay, let's run through. Selling price 15, inflation 5%. So selling price current means year 0, 15, and variable cost 6, 4%. So this is current 6 and 4%, 15 and 5%. Number of unit also I put it down here. Okay, so number of unit here. So that will give you the operating cash flow. So in fact, you can actually put down the fixed cost first. So in the exam, you stay very flexible. Which one you want to fill in first, no problem. Okay, so we work through. Later I just tell you where do you start first. So let's work through first. So 5%. So 1 year later should be more by 5%. You take 15 multiply by 1.05, you should get this figure. And then in your calculator, you multiply 1.05, you should get this figure, and so on until year 4, 4-year project. The same you do for variable cost, year 1 to year 4, and then you will get hold of the selling price, multiply number of units, you should get this sales of 39,375. Okay, 16.54 multiply 4,500, you should get 74,430. All this you work in terms of thousands. If you want to work in millions, you are welcome. Okay, so you can work in millions, then you save the 30. If you work in millions, you may want to keep 1 decimal point, no more than 2 decimal points. In the exam, don't worry how many decimal points, simply because the marker will have many suggested answers. So you have 1 decimal point, you have 2 decimal points, you have millions, you have thousands, and so on there. Alright, so go through, then you should practice based on the same question. Then you gain the speed, you gain the format. Alright, so we handle sales and variable cost. Fixed cost is simple. Fixed cost start in year 1. 4.5, you minus 2, you have 2.5 in year 1. After that, you will increase by 6%. So multiply 1.06, you get this figure. Multiply 1.06, you get this figure, and so on there. Okay, you can total it. You have the operating cash flow, followed by taxation 30%, delay 1 year. So this is inflow, and then this should be outflow. So you have until year 5. So just remember, 4-year project, if there's a delay, you should have 1 more year here. Okay, and initial investment, that is your capital cash flow, 50 million year 0, and followed by tax save. Okay, so your allowance, it is on a reducing balance. So this is working here, investment 50 million, and then they say that there's no scrap value, note number 7, you have a 0 at the end of year 4. Allowance, you see, is 25%, reducing balance, start in year 1, so start in year 1. So year 0, your balance is 50 million or 50,000 here, and you multiply by 25%, your allowance start in year 1 will be 12.5 million. Okay, so you are allowed this figure here, and that will reduce your balance to 37,500 because you already claimed 12.5. And then again, you multiply 25%, you claim another 9,375, that will reduce your balance to 28,125. This figure minus this figure, you got the 28, and so on there. Come to year 3, you have claimed 125,937,57031. You left with this figure here. That will be your balance in year 3, and then year 4 you'll have 0 scrap value. You claim everything. So you take 21,094 minus 0, you claim this figure here. So this figure is called balancing allowance. So you notice that you claim it this way, that is 12500 937,021, etc. there. So this will be the total you claim. Government say that you spend 50 million, at the end you get 0. This will be the cost for the project. So they allow you to claim it this way. So if you take this 4 figure, add together, it should be the 50 million there. Okay, so this allowance here is reducing your profit. So this allowed as expenses. So your profit will go down by the allowance multiplied by 30% tax, and it's delay 1 year. So 12500 multiply 30%, you have 3750. You can have it in year 2, delay 1 year. So this figure now transfer over and put it down here. Okay, so all now you can total it. Here the net cash flow, and last you have the discount rate. So discount rate, we want to have the nominal. Since all these are the nominal or inflation cash flow, all this adjust for the inflation already. Okay, so they give us the real of 9% and inflation 4.3. We can use a feature. Nominal should be 1 plus real, multiply 1 plus inflation minus 1. So real is 9%, inflation 4.3, and then minus 1. And you also have the country risk premium of 5%, so if you add another 5%, you get around 19%. In exam, you can use 19% approximately. So that you can use the present value table. 19%, the present value table is page 2. So you look at 19% here, 0.84, 0.706, and so on there. And just put it below, you will have the discount factor at 19% there. Okay, so you multiply, you will have the present value, add it together, you get 27,875. That means to say that the inflow in present value is more than the outflow in present value. If you accept this project here, company's value or company's wealth will go up by 27,875 million. So you should accept the project because it's a profitable project there. Okay, so you may stop the video anytime you want there to digest the information. Okay, memorize the format, practice. So that is a part A there. And part B, why do you calculate the discount rate this way? What is your reason for it? What's the reason? So there are basically two reasons here. One is the inflation cash flow. So the nominal cash flow we call it. So we have to use a nominal cost of capital. Okay, that's why we use a Fisher's equation. The second thing is this is for domestic and this is a foreign there. We have to add the 5% there. So you should be able to explain this one. Okay,